G'day guys, it's Michael Beresford again from Open Wealth Creation for today's Wealth WOD, or our Property Wealth Workout of the Day. What I'm going to talk to you today about is, how to get the best structure in terms of using borrowed money or equity or cash for investment. So we get asked questions all the time about, do I put cash in here? Do I take redraw here, or do I set up some equity here and use that to fund the investment property? As a general rule, you're going to be far better off using equity to fund investment properties rather than cash, because for two reasons. First of all, the interest that you accrue on the equity that goes towards investments is tax deductible. Okay. The second thing is, if you have surplus cash savings left over, they're far better to be either paid off your mortgage or sitting in an offset account where they're getting you benefit. The reason being is that every single cent of your mortgage is paid for out of cold hard, out of the back pocket. So if you can reduce that and maximize your tax deductibility, then your cash flow is just far better in terms of the overall scenario there. I'm going to use a specific example to illustrate this that we got asked recently, and the situation was that someone had built a new house on a block of land, but their building contract had only included the house itself. So all of the other things that are required to actually make a house full turnkey or fully complete is obviously a driveway, landscaping and so on. Now let's say that the driveway and landscaping, clothesline, water tank perhaps, all of those things inclusively are going to cost 30 or 40 grand. Now, if 30 or 40,000 is available to you as cash, then you could use that cash to pay for those costs. What would be far better is by using existing equity in either your home or an existing investment property if you have it to cover that. And if you are able to do it that way, then there are two ways that you can get your hands on that money. The first is through an equity loan. The second is through a redraw facility. Now this is really important to understand the difference, because the end result is the same in terms of getting your hands on that 30k of equity, but they have very different implications for what it means for your cash flow. For example, let's say this is your existing house and you have a mortgage on that, and here's some available equity that we're able to tap into to cover this 30 or 40,000 cost. Now, most people will say, oh, I've got a redraw facility and I'll take that money out. What happens there is redraw would actually increase your mortgage. So this extra debt, the 30 to 40k that you take out, the source of money that's going to be used to repay that is 100% your salary after tax. Not ideal. Whereas if you set up a separate equity loan, then you can use this money to cover the 30 to 40k, and because it's a separate loan, your mortgage stays the same and you get tax deductibility on this 30 to 40,000. And when you extrapolate that over the life of the loan, 20, 25, 30 years, it's going to make a massive difference to the amount of money that you're repaying to the bank. Okay, so takeaway points here, guys. Number one, if you've got equity, always use that for your investments instead of cash. Use cash as a last resort because it's better for your tax deductibility. Secondly, when you're accessing equity, make sure that it's not through a redraw, but through a separate loan where your accountant can fully show that transparently that the interest on that money is for investment purposes and therefore tax deductible. Hope that helped.